Right, so I'll keep this snappy, 20 minutes. So we're going to, when I was given this brief, I think back at Christmas, it was investing in uncertain times, so 2019 and beyond. So we're going to look at a few key themes going forwards. But before I do that, another disclaimer, very important. If you could please look at that very briefly. So then we're going to very quickly look at what we've seen so far, which is the bit I'm really good at, because even I can read the newspaper and dig the data out of the machine. It's the forecasting bit that's a bit trickier, but we'll then look at 5 key themes, and more importantly, how you can track them very easily without having to pay for lots of data, and then hopefully a few helpful conclusions for you. So investing in uncertain times. Well, I know the screen's gone red today, but so far this year, uncertainty? Don't think there's been terribly much, has there? It's been pretty much risk on. I mean, most things that you could have bought were, generally speaking, giving you a positive return this year. There are a few exceptions, but not desperately many. And I think a lot of that dates back to the 4th of January, with a big policy U-turn from our friends at the US Federal Reserve, when in between meetings, Chair Jay Powell put interest rates on hold for the rest of the year, it seems, and then in the March meeting actually began to suggest that the process of withdrawing their quantitative easing stimulus or quantitative tightening would start to come to an end by the autumn. And in fact, the market is now even pricing in around a 50% chance of an interest rate cut by the end of the year. In addition to that, I guess cheap money fueling hopes for better returns from markets compared to the late slump last year. You got the hopes for a second half upturn. Lots of companies are talking about things being a bit tricky in the first half of the year, but don't worry, it'll all be fine in the second. And that's particularly prevalent in one of my old areas, semiconductors and technology. This one's obviously particularly timely today, hopes for a US-China trade deal. I think we've had several announcements recently from President Trump that there would be a deal. He's now suggesting that if there isn't one by the end of the week, things could take a little bit of a turn for the worse, which is what's upset everybody yesterday and today. Except for today, there's generally been very little volatility. And oil price is probably been a big surprise this year. And gold, if there is one thing that's done badly this year, that's one of the asset classes that's remained out in the cooler, which I think, again, reflects that, generally speaking, uncertainty that we saw last Christmas has largely dissipated for now, and everybody seems, or the majority of people, seem pretty bullish in the world. And you can see that in the way in which the volatility index, the VIX, has performed, or even that story in the Financial Times last week about how hedge funds are now queuing up to, again, short volatility and go short the VIX because they think things are going to stay as flat as a mill pond for some time to come. So what's that all meant? Well, these are just some of the major asset classes, and the data is about a week out of date, so forgive me for the sort of shenanigans we saw on Monday. But oil and the grey bars, by the way, are local currency returns, total returns, so including any yield. And the red one's probably a little bit more interesting for you because that's the total return in sterling terms, which I'm guessing is probably how you look at the world. So oil has had a fantastic run, and then from being in the outhouse at the end of last year, the FANG companies, the NYSE FANG index, well, they're back in the penthouse, and you've obviously seen a lot of enthusiasm again for tech stocks this year, and developed market equities have done very well. And then you get further down here, equities have beaten bonds hands down, and gold has, as we already discussed, been the tail end Charlie. And that is a complete reversal of 2018, when in total return sterling terms, pretty much the only assets that gave you a positive return last year by cash were German bunds and gold, which is a pretty funny-looking bull market if you think about it. So a lot of the risk appetite dissipated late last year, but has bounced back in style, and a lot of it is down to the fact the Fed has suggested it's not going to drain as much liquidity from markets as it previously suggested. Interest rates might not go as high as previously suggested, so cash and bond yields aren't as much of a competitor for equities as they once were. USA, top of the pile, making America great again. Well, if you benchmark the Dow Jones Industrials, it's working, and the S&P 500, it's working pretty well. Western Europe, UK, holding its own for all of the political issues that we've had, which I'm going to try and gloss over very, very quickly. And emerging markets, slightly towards down the farther end there, but again, US first, but no shortage of good performance from equities. And this is a major reversal from last year. Telecoms and healthcare and utilities were at the 3 best performing sectors last year globally. They're the worst ones this year. Tech's back to the top of the tree, followed by industrials and consumer cyclicals. And bonds haven't disgraced themselves by any means, but it's interesting to look at which bond classes have actually done best. UK high yield, US high yield, European high yield. The riskier end of the spectrum, one would politely suggest, where again, investors are reaching for yield because interest rates remaining anchored at levels perhaps a lot lower than we'd have thought 6 or 9 months ago. So that's where we've got to. Again, I said the bit that I'm really good at. Now some tricky things just to look forward to what may well shape sentiment for the rest of this year and beyond. Central banks remaining centre stage, probably I'm afraid to say. It's a bit tedious for somebody who was a trained stock picker, having been a fund manager and a financial analyst. I'd rather be talking about things bottom up, but there's going to be a lot of top-down influence. We do have to talk about trades. It's lucky I put that in. The yield curve, the dollar, and the B word we'll very quickly deal with at the end. So this is a chart that takes me a long time to put together, but it is. The grey bar is the year-on-year change in the big five central bank balance sheets in dollar terms. So the Fed, the Bank of England, the Bank of Japan, the European Central Bank, and the Swiss National Bank. And it compares it to the year-on-year change in the FTSE All-World Index. And what was very interesting, particularly late last year, as the Fed began to shrink its balance sheet and withdraw up to $50 billion a month of stimulus, it was draining liquidity away from markets, bond yields were going up, and equities began to feel the strain. And if anything, you saw a bit of a domino effect in a classic sign of what you could have seen as a late market development. Bitcoin went first, volatility strategies fell over second, emerging markets fell over third, FANG stocks fell over fourth, and then developed markets, kind of right at the core of the situation, caught a cold just before Christmas. And that's the sort of thing that you tend to see. Risk appetite bleeds away from the periphery, the riskier areas first, and then finally comes home to roost. And a lot of that was down to the Fed taking away the fun money, the cheap money, basically. Now, that seems to be coming to an end. The Fed said it may well stop doing that by October. OK, the Bank of Japan is still printing, but the Swiss National Bank is slowing down. The Bank of England hasn't added. But the European Central Bank, having said in December, January, no more QE, quickly began to promise more cheap credit for banks to start lending with in October, if they can find somebody that they wish to lend to. So you are still seeing a shrinkage in central bank balance sheets potentially until around the autumn, but for the moment, equity markets don't seem terribly concerned because there's almost a suspicion that if things do get tricky, the Federal Reserve's got their back and it may even hit the print button should the next recession come and start going back to QE again. Sufficiently dovish have been some of Mr. Powell's recent statements. And again, that's providing liquidity and it's driving a reach for yield. TINA being, again, one of the phrases, there is no alternative to equities when it comes to looking for some decent yield for investors' portfolios. So that's a key theme. So we are going to have to keep on listening to what particularly Mr. Powell has to say. Japan still seems keen to print, and Mr. Carney, we'll see whether he gets around to doing anything before he departs in January. But it was interesting listening to a commentator on the Radio 4 Today programme last Friday, and she said, well, nobody listens to Mr. Carney anymore because he cried wolf so often his credibility's shot, which was interesting because he was about to be followed on the programme by the Deputy Bank of England Governor, so that was quite interesting. Trade, well, this has been a hot topic today. Clearly, President Trump is now getting a little bit more aggressive, talking about adding another 15% to existing tariffs and even bringing in another $300 billion worth of Chinese goods under this. You can see how it's starting to affect trade a little bit. You can see it in Asian GDP numbers, particularly Korea and Taiwan. You can see it in the CPB world trade numbers, which are now actually falling year on year in terms of global trade flows. But an easier thing for you to track as to whether this is actually just talking heads getting excited about nothing and harping on about 1931 and how Smoot-Hawley made a global economic situation a lot worse as tariffs were put on goods and global trade began to shrink. But one of the quick ways in which I can track it, or like to track it, is through the SOX index, which is the Philadelphia Semiconductor Index. You can follow it for free on Yahoo. It's 30 global silicon chip and silicon chip making companies, silicon chip equipment making companies. Why is this handy? Well, there are two reasons. One, semiconductors, it's a $400 billion global industry, and silicon chips are pretty ubiquitous. So they're in everything from your smartphone to your car to your smart meter at home, your television, you name it, they're going to be in it. So in that respect, they're a reasonable proxy for economic growth, particularly now it's a pretty mature industry. And also from a stock market perspective, they're a great uncertainty, or in fact lack of uncertainty guide. When everybody's feeling pretty bullish, economy's going well, these are momentum stocks par excellence. The momentum jockeys pile into them as earnings estimates go up, but they pile out of them just as quickly when earnings momentum roll over and you start to get downgrades. Now, as you can see here, the SOX index fell right out of bed in the second half of last year as global economic worries began to build, and more and more of those companies begin to dish out profit warnings and also talk about an inventory pile-up, particularly in China, particularly in Asia. This year, Mr. Powell has said to everybody, don't worry, it's all going to be all right. and the SOX index has actually hit new all-time highs, even though Intel, Texas Instruments, Nvidia, and some major heavy-hitting stocks from this index have kept on saying, second half, yeah, we think it's going to be okay, but they've begun to back off on that a little bit. So it's going to be very, very interesting when we get to July and the guidance for the third and fourth quarters, whether they stick to the second half recovery story or not. And I pointed out here how quickly these stocks fell out of bed last year. If you take history back to when this index began in 1994, it's generally tended to roll over 6 to 9 months before the major indices. It did it in 98, it did it in 2000, and it did it in 2006-07. Now, in case I've got any compliance officers there's bound to be one hidden in here somewhere. I admit that history is clearly no guarantee, the past is no guarantee for the future. But so far, it's set me in relatively good stead. So we'll keep an eye on that one very closely. It could be a good barometer for trade. This is a source of great controversy because some people love it and some people hate it. Some people argue that it's broken because of central bank interference in the bond markets through QE, which are artificially crushing interest rates. But in theory, if you lend money to America for 10 years, you are going to want a higher interest rate than if you lend it to them for 2 years, just because more things can go wrong in the interim, whether it's the economy, whether it's inflation, or whatever it happens to be. You are going to demand that premium to compensate you for the extra 8 years' worth of risk. So generally speaking, the 10-year will yield more than the 2. Now, what we saw last year consistently was the gap between the two falling as short rates began to rise and long rates began to come down as the market pricing short-term interest rate increases from the Fed, but then that it would recant, overdo it, and actually start to cut long-term rates further out. And that's why you got the premium sliding from 80 basis points, which is historically quite thin anyway, down to almost 0 at one stage. Now, if that goes negative, most economists will say to you, inverted yield curve means there's a US recession coming. I think it's probably warned of about 10 times ahead of the last 5 or 6 recessions. So it's not perfect, but it's generally been helpful. But people will say because central banks are actively buying bonds to actively depress bond yields, it's not so effective. So we will see. But you have seen, for bulls at least, thankfully, that premium just begun to go up. The yield curve has just steepened a little bit. Keep an eye on it. Lots of people will talk about it. If it goes negative, normally a sign for trouble. Certainly, I'd imagine there'll be a few central banks looking at it. But at the moment, after that panic last year, it's just starting to go the right way. The dollar. Very strong. Now, again, you would think that perhaps, given that the Federal Reserve is now less aggressive with rate rises, the dollar might have softened this year, but it hasn't. And the DXY or Dixie index is actually a bit of a high right now at around 98. And that's nothing compared to the peak of 120 it reached in the 2007, or indeed 160 in the mid-1980s. But nevertheless, the dollar is on a march right now, and if history is a guide, it's not always a good thing, because it can make life very difficult for emerging markets, particularly those that have borrowed heavily in dollars, which is why there's a lot of pressure on Turkey and Argentina right now. And it can be a bit of a negative for commodities because they're priced in dollars, except for cocoa, so they tend to get a little bit more expensive. So the dollar being strong isn't always a good thing for risk assets, so it's intriguing to see it creeping up, probably because the US economy is continuing to surprise actually on the upside, despite the US Federal Reserve putting interest rates on hold. So we'll keep an eye on this trend, because it's not always the most market-friendly one. I'm going to not talk about politics in this at all, because I will automatically upset 52 or 48% of the room. But what I will say is that sterling is probably the lightning conductor right now from a market perspective, because the Bank of England sat on £435 billion of gilts. So again, the gilt market is where you would normally expect markets to express dissatisfaction or satisfaction, because if they like an economy, they like a government, they'll charge it a low interest rate to borrow, and they don't like it and they're unhappy, they'll charge it a higher one. The 10-year yield right now is very low, so partly because the Bank of England sat on lots of the paper. So sterling's the lightning rod, and at 130, it's kind of saying I'm not quite sure what's going to happen here, because it started off at 150. Economists tell me it could get to 1 if there's a hard Brexit and people get frightened for it if they think it's a bad thing. So watch sterling as a short-term lightning rod. Gilts minding their own business. And the FTSE 100, for all it's done well relatively over the last year, has been a serial underperformer since Brexit. It is unloved, and therefore you can perhaps argue it's time to have a look. There was actually an article in the FT before Christmas when a fund manager described the UK as uninvestable, which to me automatically got me extremely interested in it because, uninvestable sounds a little bit too much like unsinkable, said the Hindenburg to the Titanic. So once people start suggesting things are uninvestable, I'm automatically interested. Anything that's embarrassing to one, feels smelly, makes you feel soiled, it's normally of interest because it's probably cheap. And the UK, looking at this, is just one way I look at it. The red line is the FTSE 100's dividend yield minus the 10-year gilt yield. And the premium's currently about 3 percentage points. Now, since the financial crisis, whenever that gap's got to 2 percentage points, the market's gone up. It's currently 3. So on that basis, you can argue there may be something for income seekers to look at here. 2 obvious caveats. Gilt yields could go up. Doesn't seem likely at the minute, but you never know. Or, of course, the dividends could come down. And Marks & Spencer's has cut, and there have been a few other cuts this year to keep us on our toes. But for the moment, at least, it's easy to argue the UK is cheap, not least because it feels desperately unloved. And fund flow data would suggest as much as well, looking at the Investment Association figures. So we all know there's political uncertainty and but a lot of that may be reflected in the valuations. And this is really my key point. This man died a billionaire, so if you don't want to listen to me, at least listen to him. Bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. And there's no shortage of pessimism surrounding the UK equities right now, perhaps just because of the political situation, but also perhaps the economic one. So that's certainly a starting point. And if you think that following euphoria is a good idea, think again. This is December 2017, when they were probably enjoying themselves enormously. I'm not sure they've enjoyed themselves quite so much since as that chart of Bitcoin would suggest. This is not to take the mickey, because in fact, over the last 9 months, how many questions have I received about Bitcoin? None. And it started going up again. See my point? So, this is just my guess, feeling, instinct, based on questions I get from the press, things I'm asked to talk about when I'm on the radio or the telly, things that journalists are interested in. Right now, what's out in the cold? UK equities and sterling, nobody's interested. Now, some of this maybe you may think is perfectly justified. There are clearly big structural issues to address with real estate and physical retailers. European equities, crypto has gone from hot to nothing, and value investing still feels like pretty tough sledding. There is a degree of skepticism, certainly on precious metals and miners, where nobody's interested at all. Banks are continuing to underperform. Japanese equities, I don't get any questions. These are the areas where people are constantly ringing me up. US equities, the dollar, oil, healthcare stocks going a little bit colder now, and momentum and growth investing just the only game in town, it feels right now, hence why the chip stocks are doing so well. And where are people getting all hot and bothered? Tech and FANG stocks, and we got the Uber IPO this week. Cannabis stocks, private equity, lots of debt being raised very easily, residential property, and then index proliferation is interesting just because there are more indices out there now than there are individual companies, which intuitively makes me feel a little bit uncomfortable. We love ETFs as an option to consider as part of a balanced portfolio, as an option, but it doesn't matter if the thing's cheap if the underlying doesn't do you any good. And Bloomberg and Morningstar both produced a piece pointing out that 80% of themed ETFs that have opened in Europe since 2012 have now closed. So it doesn't matter if it's cheap, but if you're buying into the theme at the top, you're going to find yourself in some difficulty. So this is just my take on it right now as to what I think is out of the cold and therefore potentially cheap and interesting, and where you may just need to be, I'm not saying panic, but just be a little bit more careful. And one example of this, Zoom 1, efficient markets hypothesis nil. You may be aware that one of the unicorn companies that's floated recently is called Zoom Video Conferencing. It's the grey line here. It's only been trading for about 10 days, and the shares have doubled. Fair enough. Some good IPOs have done that over the last 6 or 9 months, and that's all well and good. But this is a company called Zoom Technologies that doesn't trade on NASDAQ, but it quotes on the OTC, the unquoted pink sheet market in the US. It's a loss-making Chinese modem company. It's been around forever. But because people thought this thing was the hot one, the share price has gone from 1 cent to $5. Now, that's not necessarily a good thing. And all I would politely suggest is that the less care that people take with their money, the more care you should be perhaps thinking of taking with yours. And just as a final point, one thing that we all tend to do is over-extrapolate from what we're used to. And right now, the markets are saying inflation's dead, right? Goldilocks economy, not too hot, not too cold, no interest rate rises coming, thank you very much. We're all off to the races. And that's Bloomberg Business Week, a magazine I enjoy reading enormously. And this is not to poke fun. We all get things wrong. but this is a magazine that has particular form with such stunning declarations. Because that's Bloomberg, or Business Week as it just was then in 1978. The death of equities, how inflation is destroying the stock market. And that article came out there. Yeah. It's really, really, really easy to do, because that's just human nature. So just be careful that the narrative that we've been used to for the last 10 years, something could come and change it. You just don't know. And if there's the biggest change in narrative coming in the next 10 years, it's that inflation will come back from someplace, because right now nobody's expecting it. And intriguingly, Charles mentioned Mr. Buffett, so just to finish, this is what the sage himself is doing. Most of the attention focuses on, at the moment, the mess is made of Kraft Heinz, but also the fact that his cash pile is still going up. But the line that interests me is his fixed income allocation, the red line. It's at record lows. Now, Buffett doesn't make macro calls, so he says, but he may well at least be saying he thinks bonds are terribly expensive given the yield that you're going to get, and if at any stage interest rates go up, you've got a potential problem. Thank you very much for your time, everybody. Bang on time. Charles, you have the phone. I look forward to talking to you at the end.